talk about it, Jermal, the leap from options to futures, starting out with the futures contract. And I got very punny with this one, a simpler option.
Oh,
See
I
that?
see what you did there. I
Yeah,
see what you
there
did there.
we go,
Okay,
man. This
all
is going to
right.
be a fun one. You already talked a little bit about what a futures contract is with my good friend Peter Molmat. We're going to be doing this twice a week. Pete's going to jump on with you, cover some ground. I'm going to jump on with you later in the week, rehash that ground, build on it, and hopefully we get somewhere. With that being said, let's cover what you went over earlier in the week. What is
Okay.
a futures contract, my friend?
Well, it would appear that a futures contract is a legal agreement to buy or sell a particular asset at a predetermined price at a specified time in the future. Now, I can get behind this because it's very similar to option, like you said, using that pun. I mean, you're looking at some point in the future where this thing is going to expire. But in the meantime, it's a legal agreement. You have whatever particular asset, and I'm pretty sure down the line, we're going to talk more about the different kinds of particular assets that we can get into. And there's that specified date, which is that expiration, correct?
Absolutely, man. And I'm so glad that you brought up the similarity to an options contract, because this is something that I want to work to unravel over the course of our friendship and our time here on the program, which is like a legal agreement to buy or sell a particular asset at a predetermined price at a specified time in the future. That is boring. And a lot of people think, they look at the futures textbook and they say, I don't want to deal with that. They look at this definition, they go, this doesn't sound like the kind of fun I want to be having in my trading platform on a Thursday afternoon. But you brought it back to the fact that options, which a lot of people over the last decade have jumped on board with and have a blast with, similar definition, right? Like it's just an options definition. Let's think about the call option to start out here. It's simply a contract that if you buy that call option, lets you at a future date potentially buy that asset at whatever strike price. Like it's not the most fun definition, but you got to get it in your head to build some ground here. And with that, let's build a little bit of ground. Let's go from definition to what we're actually dealing with when you are, for instance, long a future. What's going on there, man?
Yeah, so you're right. Those definitions are always like not sexy, right? And so we just got to make it literally. The idea is you're buying a future so that you want it to go up, right? You want it to appreciate, and so that's where this part, makes it even simpler, right? You're obligated to buy an asset at a price of the futures contract on some date in the future. Then you want the price to move higher between now and that date. And again, I can get behind it. Like you just likened it to a call contract. So your longer futures contract, you want it to go up, you want it to appreciate. That's how you make money.
Yeah, and this is really, like I said, what I want to kind of unravel, or at least work down some of the negative connotation that comes to futures. It's like futures, like I don't want to have to deal with that. I don't want to have to deal with derivatives. I don't want to have to deal with the forward curve, all of that crap. Guess what? I read a lot of those textbooks, and when I was trading overnight at the Chicago Board of Trade, sat there reading white paper after white paper. And you know how much it has done to help my trading? Nothing, nada, none at all. Right. Because long futures, you want the asset to go up. If you buy the future, you want the thing to go higher. If you sell it, you want it to go lower. That future date, that expiration, or the obligation, all of those big lofty words mean nothing. It's the same as if I bought the S&P 500 ETF shares, guess what? I want it to go higher. If I bought the S&P 500 futures, guess what? I want it to go higher. And let's continue along this path a little bit, because we're hitting a nice stride, making the futures contract akin to the options contracts that you're so used to. Because here's the way I view it. You've got essentially long calls without the premium, short puts with upside. You put those together, you have the synthetic long with options. Right there, you have a futures contract. How is this not, to me or you, a simpler option here? One futures contract, two options contracts coming together in what looks like a Pokeball here on the slide. But maybe you can look at this a little bit, because I'm sure you've looked plenty of times at long call, short put. That's just the synthetic long of the market. Futures they're kind of like this, right?
Yeah, they're exactly like it. And what's so funny about this is that, when you start trading, especially the way that I trade, starting at a prop firm, And we were taught about the idea of trading vol, not so much directional, right? And so the idea of just buying long call and short put was sort of frowned upon, as far as like, if you're going to do that, you might as well turn it into, a reversal and sell stock against it, right? So
Sure.
that was always kind of a big deal. But here, this is exactly what a lot of people just want to do. Say you just want to get long, right? You could literally go out and buy that call for premium, and you could sell that put. And these are two bullish type of deals, right? These are bullish assumptions. So this is what you want to do. So the idea of here on, as we have on the slide, futures are kind of like long calls with a higher probability of profit, or short puts with unlimited upside, which, sign me up for that, dude. Like, okay, I want to do that.
Well, so because here's the thing, like, and correct me if I'm wrong, if this isn't how you experienced it, but the first time that I experienced options in the real world, outside of the theoretical textbook and all that crap, the classroom, whatever you want to call it, was essentially a guy being like, I'm going to buy these calls because they're so cheap. And if I lose, then I lose, but it's not as expensive as the underlying market itself. It's like the lottery ticket thing, where it's like, all right, I'm going to spend $50 on these calls in Tesla. If it gets up there, then I made, 5-10 times my money. Yippee, hooray. And if not, then I lost like $50 or $100. It's leverage, man. That is what we're talking about with that first instance of like, oh, buying a call. That means that I don't have to put up the full stake of the underlying market, and I can get exposure. I want that thing to move higher. Same with futures, man. You get the leverage of not having to put up the full worth of the market, and you just want the market to go higher. The difference, though, every time, and this is, you talked about volatility, so you know this, maybe you could speak a little bit to this. Every time you buy a call option, whether it's in the money, at the money, or out of the money, your probability of profit is going to be a little less than that 50-50 of the market just going higher or lower, that theoretical what it should be, because you're paying a premium. Futures don't have that premium. They give you the leverage. They give you, like I said, the ability to see upside without, putting up the full 100% or 50%, like buying shares in ETFs and stocks. But it's a higher probability of profit. You don't have to put up that premium. That's pretty big, right?
Yeah, it's pretty dope, man. I like what you did there. And it makes it an interesting combo. It's almost like where we started at, this idea of football versus baseball. Like, they're different sports and they're different rules, and there's different ways to look at it. And so, even here, when we're talking about options and we're comparing futures, as I'm starting to really like work on it in my brain, or even just kind of retool some of the thoughts that I've had in the past about it, I look at it now as far as like, yeah, you're right. There isn't that premium that, when we're just talking about as far as buying a call, there's not a situation where there's like this intrinsic value and there's this premium where you're buying a call for whatever reason, and it's supposed to have a certain value to it. A futures contract is like, you're looking at currently where it is and you're where you believe it could be. And so you're just looking at it from simplistic view of that point. So that's how I'm sort of getting around to it in my brain.
Absolutely, man. And let's finish here, because I think that this is a good jump that we've made this week, of a great first stride here with you on the new show, on the network. We're loving it. And we're going to make so many more strides into expiration, into pairs trading, so much different stuff that we're going to cover. But starting with where we started, with that true, textbook definition of futures contract, and where we're going to conclude here today. Wrap this up for us, Jermal. What is, at the end of the day, a futures contract? And we're not talking about that textbook definition. What is it when you're just a trader opening your platform, looking at, for example, the small stocks SM75 futures?
So a futures contract is an efficient stand-in for a given asset that lets you buy or sell with relative ease. And looking at this, I should have bought SM75 in 2021, because holy cow, things have been on the move, right? But when I see this, it makes me think of how small stocks have rebounded this year. Small stocks in general have been this proxy for the improvement in the economy for the most part. And so this is no surprise from, given what we've seen. I mean, small stocks have really taken off to begin the year.
I'm super excited to, get to a point where we're just talking about, the small stocks versus the small technology and all these different moving pieces. But at very least, what is nice about looking at this is you see that rise, and it's like similar to people who traded call options in GameStop or Tesla or anything else. and you would say, oh man, if I bought that call, then I would have made 5, 10x my money. Now, of course, if you bought that call and it moves lower, then you lose a bigger percentage of your money than the outright itself. Same with futures. Through this whole run, this big bullish run since the pandemic broke out in the early part of 2020, SM75 futures, Jermal, have cost you about $500. Now, what we see here is a move of $4,000. So that's what we're talking about with what futures afford you. Very similar to that call option, whereby if I buy it, I can make, 2, 3, 10x the money that I lay down because I don't have to put up 50 or 100% like trading shares of stock. And it's really that simple. It's the leverage, the efficiency that you're afforded. And at the end of the day, you buy it, you want it to go up, you sell it, you want it to go lower. I think it's, if anything, simpler than those options, learning about calls and puts and everything else. If you've learned about calls and puts, buying and selling, those are 4 different permutations already.
Yeah, right.
You've got to be able to get on board with just buying or selling a futures contract. That's only 2. And 2, to me, simpler than 4, man.
It is simpler. And, it sounds like your job is simpler than mine as far as explaining it to people for the most part, because you're right. It is always that thing of getting people to understand the idea that, there's those 4 permutations with, the calls and the puts, and that you can do that versus here, you can just buy something and it goes up, or you can sell something and, you want it to go down. Just that idea of long stock and short stock, on the stock and option side, but this is a totally different ball game. And it's easier, dare I say. And I'm not just saying that, it's true. I mean, it's a lot simpler than the idea of options from what I'm used to. So I like that. I mean, let's keep it going. Like every show, we did this with Pete, doing it with you, man. Like, this is awesome. Like I'm starting to feel more like, okay, I can trade futures contract.